Hello, my name is Jack Elder, Senior Director for Advanced Planning for Comprehensive Brokerage Services. Today, I'm going to be talking about intentionally defective grantor trusts and how life insurance can integrate. Over the next few weeks, we will be focused on the different uses of grantor trusts. So this week, I'm going to talk about, kind of some of the foundational information. And then over the next 4 installments, we will cover the power of IDGTs with strategic gifts, what are installment sales to grantor trusts, how to use split dollar with grantor trusts, and finally, creative planning with grantor trusts is a way to roll out of premium financing arrangements, whether that's coupled with installment sales or split dollar or strategic gifts, to really put your premium dollars to work for you in the most tax efficient way possible. So in all cases, we're going to be talking about clients that are high net worth, that have income producing, appreciating assets. Commonly, it's a privately owned business or rent producing real estate. These clients are concerned about efficient wealth transfer. And because insurance is a crucial component, they're also insurable. So let's start off with what is an intentionally defective grantor trust. I am not going to spend a bunch of time talking about the Internal Revenue Code or how to ensure a trust meets the definition of an intentionally defective grantor trust. That's the job for the drafting attorney. I'm going to talk about the tax benefits, what it means in relationship to life insurance. The way I like to think of it is the Internal Revenue Code, puts different glasses on and off for different assets and transactions. So from an income tax perspective and an estate tax perspective, each one of these viewpoints views intentionally defective grantor trusts differently. Let me explain. If you've got an intentionally defective grantor trust and it has items of income and deduction or capital gains, the trust is ignored for income tax purposes, and all of the income taxable amounts realized end up on the grantor's 1040. It's as if the IDGT doesn't exist for federal income tax purposes. This creates 3 distinct tax planning opportunities, which I'll cover in a little bit more detail: gift tax-free transfers, estate tax burn, and tax-free transactions. I'll come back to those in a minute. From an estate tax, the way the estate tax works is you add up the value of all your assets, you apply any deductions that are available, and then you take out an exemption, and then you apply a rate. From an estate tax perspective, assets owned in IDGT are not included on the grantor's in the grantor's taxable estate. So you end up with this kind of split personalities with intentionally defective grantor trusts. From an income tax perspective, the trust doesn't exist. From an estate tax perspective, the trust does exist, hence the name intentionally defective. The benefit here for wealthy families is that they can have the opportunity to move future appreciation in gifted assets outside the estate tax system. So what are those tax benefits? I'm going to hit 4 of them: gift tax-free transfer, estate tax burn, tax-free transactions, and moving future appreciation outside the estate. So let's assume an IDGT owns 100,000 shares of YYZ stock. It purchased it 5 years ago at $50 a share. Now it's going to sell that stock at $75 a share. That's a capital gain of $2.5 million. The trust, because it does not exist for income tax purposes, does not pay any income taxes. Instead, the $500,000, assuming a 20% bracket, that $500,000 of tax hits the grantor's 1040. The payment of that tax is essentially a tax-free gift. You do not need to file a gift tax return. It does not count as a gift, does not count for your annual gifts, does not count for your lifetime exemption. The payment of that tax is a tax-free gift. That's huge. It's only available with this type of trust. Second, the payment of those taxes increases the trust's rate of return. After taxes, that trust would have returned 8.78% on that transaction, the purchase and sale of the YYZ stock. Well, because that trust's not paying taxes, it gets what I call a pure rate of return undiminished by taxes. It's a 10.67% rate of return. So the amount of growth available in that trust has no tax drag on it, has a huge over the long term impact on the wealth transfer. And oh, by the way, the $500,000 that grantor paid in taxes is not going to be subject to estate taxes someday. So let's say this individual had used up their exemption, that $500,000 would be taxed, let's say at 40%. Instead of paying $200 to the government on that 500, had it been in your estate, it's zero. You burned the estate, therefore you burned the estate tax exemption. The payment of IDGT income taxes over time will burn the grantor's estate. I mean, you take that 500, you compound it into the future, it could be a sizable number. Well, those taxes the grantor would have paid anyway are now being paid on behalf of the IDGT and lowering the grantor's exposure to the estate tax. That's called the estate tax burn. Because installment sales don't really exist for income tax purposes, when you're looking through your income tax classes, you can do transactions with the trust and not have income tax consequences. For example, if the grantor were to sell a portion of his business to a trust in exchange for a promissory note, so that after the transaction, the business was co-owned by the grantor and the trust, the interest payments on that installment note from the trust to the grantor are not, they from an income tax perspective, it's disregarded. It's as if it didn't happen at the federal level. This creates a very powerful opportunity to remove future appreciation from the taxable estate. For example, let's say $10 million of that business was sold to the IDGT. That $10 million, that is a note inside the grantor's estate. If that portion of the business that was sold grows to 19 million and change, all that future appreciation, in this case, almost $10 million, will never be subject to US transfer taxes. So life insurance is essential here because that note is in the grantor's estate. So that $10 million note is there. If you assume that the asset contributed to sold to the grantor trust is kicking off income, well, it's got to service that debt. Let's assume 3.1% for now. It's paying $310,000 a year to the grantor, not taxable, non-existent from an income tax perspective. That leaves $190,000 for insurance premiums, which is perfect because that covers would be more than sufficient to cover the note in the grantor's estate. So what you've done here is you couple insurance with some advanced planning techniques, and you can move significant appreciation outside the estate, have it grow estate and gift and GST tax free. So let's recap the benefits. Gift tax free transfers, because when I pay taxes on behalf of my trust, the fact that I'm using those dollars removes them from my taxable estate, which burns my estate. I have the opportunity to do installment sales to grantor trusts or grats or any kind of transactions with my trust, income tax free. And by the way, any of the assets that move into that trust are going to appreciate outside my taxable estate. Very powerful tool. Life insurance is the crucial piece of the puzzle here. And there's a couple ways that life insurance, numerous ways that life insurance integrates. One, the trust's income can pay all or part of the premium. The proceeds are immediately available to cover taxes. Proceeds are income and estate tax free if you do it right. And the IRRs on the death benefit at life expectancy are going to range between 6 and 9.5%, depending on how the policy is designed. So as a standalone asset, it's a very strong asset that makes sense in most clients' portfolios, especially high net worth clients. These returns, of course, have no sequence of return risk, and they are not correlated to the client's other asset classes. It's frankly the ideal financial tool for efficient wealth transfer. So that's the recap. That's the foundational information that we're going to cover about grantor trusts. In the next 4 installments, we're going to talk about strategic gifts, making lump sum gifts to a grantor trust before the exemption sunsets in 2026. We're going to talk in much more detail about installment sales to grantor trust coupled with life insurance. We're going to talk about split dollars. So these are clients that are looking for a way to create liquidity outside their estate, but have earmarked their exemption for other assets or have already used it. And then finally, premium financing. With interest rates on the rise, premium financing is a great tool as long as you have a way to roll out, i.e. pay off the premium advances from the lender. With interest rates increasing, it's going to be very hard to do that with a life insurance policy alone. But with grantor trust planning, there are multiple ways to approach this, and I will touch on those. So that's what's coming up. In the meantime, just know that if you have any of these clients, we can help you model the designs, provide point of sale support with the client and their other professional advisors. And you'll get a chance to see our designs over the next 4 weeks. They're all highly actionable that you can put to work right away to help your clients address their wealth transfer needs. In the meantime, we'd love to hear from you. Here's my contact information. Thanks so much. Have a great day.